After over 3 decades of breakneck growth, China's property market is shifting into a structural reset as demand cools and inventories rise across housing and commercial real estate. At the 2026 China's Two Sessions, the government work report released signals on how policymakers plan to stabilize the property sector through city-specific measures to manage supply, reduce inventory, and upgrade housing. In this episode of Global Vision, we speak with James Macdonald, Head of Research at Savills China, about the key forces driving this shift and what signals from the Two Sessions could mean for market expectations. Hi, James. Real estate was mentioned several times in this year's government work report. How do you view the current state of China's property market? And what stage of development do you think it is in right now?
We're going through a structural transformation. This is not sort of a typical cycle. This is not a 2 or 3 year change in the market conditions, but it's more a sort of step change in terms of the property conditions. If you look at commercial market or the residential market, we've seen 3 decades of incredibly strong growth, both in terms of development and also pricing and rents and everything else. And we haven't really gone through a cycle like this before. It's a much more significant change than a normal market cycle might be. From a residential market perspective, then obviously we've seen lots of new build in some of the lower tier cities, and maybe not as much demand from potential home buyers. And there's been a mismatch in terms of where the supply is generated and where the demand is. First tier cities, some second tier cities have maybe seen a much tighter market and prices actually rise a lot faster. This is something you see everywhere in the world, but particularly in China. Obviously, there's a large population in China, and everybody wants to live in sort of the top 20 cities for the job opportunities and other aspects. And so we're seeing that sort of migration towards these larger cities and that mismatch in terms of supply and demand. So what we're needing to do is sort of recalibrate where's the supply generated, what price positioning, what does the population actually really need? Because we haven't had a breather for the last 30 years. It's just been non-stop development. And so we need to step back, look at the market, see what the market needs going forward.
Compared with the residential market, are there any different trends in commercial real estate? And given the broader situation, how do you read the signals this year's Two Sessions have sent to the property sector?
Similar for the commercial markets as well. I think there's been a sense or an understanding that China's economic growth will continue at 6, 7, 8% for the next 2 decades. But I mean, obviously the base effect that we actually have and the international sort of environment that China's faced with and just sort of internal growing pains means that we need to take a breather in terms of economic growth and again reassess how do we want to not just what pace of growth we want to see, but how do we want to generate that economic growth and what therefore we need to do with the commercial real estate market to support that economic growth. Is it more on the manufacturing side? Is it more on the retail side? And so how do we better position the commercial and industrial real estate markets to support, again, the economic direction of China going forwards? With the Two Sessions, it's about stability. It's not necessarily about growth, it's about stability. It's about putting a floor under expectations, saying that we will backstop to a certain extent the market. We're not necessarily going to support the market to go back to growth, but we're trying to reset expectations. Every Two Sessions, we will look at that and sort of see is there a shift in terms of policy, a redirection in terms of efforts. It's maybe a very gradual shift, but it's a signal to what we want to focus on going forwards. And so we'll do this every year. It's not, I mean, obviously it's a lot bigger every 5 years, but each year there will be a slight shift in terms of tone, depending upon what the external environment or the domestic conditions are like, as to how we sort of navigate back to the path we're trying to get on.
How should international investors look at China's property market today? After several years of ups and downs, does the market call for a different mindset now?
Always the thing that makes China unique is the size of the market. I mean, there's nowhere else in the world which is the size of the China market. And also the fact that we've been growing non-stop, as I said before, for 30 years without too much of a breather. And so the fact that it's so large and the fact that we've been growing for so long, for such a prolonged period of time, means that some of the imbalances in the market have built up to quite a significant extent. It's more of a transformational shift from a developing market mindset to a developed market mindset, where we're not focused on adding new supply, but we're focused on what stock do we have at the moment and how can that be better suited to the current market conditions. So I think that's quite a big difference. The opportunities in China are not the same as they were 20 years ago. The opportunities for foreign manufacturers or retailers was that there wasn't much domestic competition, and so they were filling a void, filling a need. But over the last, again, decade or so, we've seen Chinese companies outperforming international peers, more dynamic, more innovative in terms of the retail concepts, the sales channels from a consumer standpoint, and from a manufacturing standpoint, innovation, investment in R&D. And all of this is creating a much, much more competitive market where the margins for foreign companies are a lot thinner than they were before. And so coming into China, investing in China, is not necessarily saying that this is an easy market to be in, it's a big market we can sell to. It's more, in order to be able to understand where the global markets are going to be in 5 years, 10 years, 20 years' time, we need to be at the cutting edge in terms of new industries, new economies, new business practices. And China has some of that we need to learn from. We need to be in China to understand where the future is going to be versus we need to be in China to sell to the Chinese or to look at the low-cost manufacturing base. And so it's a very different investment opportunity in the China market than it was before.
According to the 2026 Government Work Report, stabilizing the property market is a key priority this year. In your view, what is the most important step to revive housing demand? And what approaches would be most effective in managing supply, reducing inventory, and upgrading housing?
So first and foremost, it really has to be demand. If you're not seeing growth in terms of demand, if companies aren't growing, if they're not opening up new manufacturing capacity or retailers aren't opening up new stores, it doesn't really matter what we do in the property sector. It's very hard for us to deal with oversupply without seeing a growth in terms of demand. So it has to be that economic growth prospects, business investment in terms of expanding capacity has to be there. Because at the moment, most sectors are tenant-led. So the tenant-led sectors, the tenant has the most power in terms of negotiation on rents, on leasing conditions. And so we need to see that shift in terms of power, not away from the tenants, but more balanced negotiation between the landlords and the tenants at the moment. So we see that growth in terms of demand. Again, the landlords have a bit more of a bargaining power, and that then signals to investors that they can start to look at that market. So for example, I'm based in Shanghai, and again, the local authorities are looking at saying, look, we've got all these old grade B buildings, grade C buildings in the city centre. We need to move those tenants from that grade B, grade C space into grade A office space, and then we can empty that building and convert it into maybe it's adult training centres or multifamily or vertical healthcare or whatever it is. How do we move tenants from older facilities, outdated facilities, into grade A facilities? How do we move them up into better quality facilities? And then how do we take that old existing stock and repurpose that for the new economy going forwards?
In recent years, China's real estate financing model has been changing. What major trends have you observed? And what new opportunities could those changes create for international investors?
I think for us, there's been a big push over the last few years in terms of the property sector, moving away from debt to equity. So again, developers took on a lot of debt. They're trying to repay that, put a lot of pressure on developers. But what we've seen over the last few years is a real shift by the government to encourage equity investment into the property sector. So that happens in two ways. One is sort of longer-term institutional investors like insurance companies, and the other one is securitization in terms of assets, such as with the REIT market. And so from that perspective, that shift from debt to equity, that shift from private to public is incredibly important for the long-term growth in terms of the property market. And it's something that we're trying to look at going forwards, whether that be from an investment perspective, whether it be from a valuation perspective, or working with these new REIT managers in terms of their leasing or property management. So we see lots of opportunities there.
Finally, I'd like to ask about Western China. As industry relocation and manufacturing upgrades gather pace, more businesses are moving inland. What new opportunities do you see for Western cities such as Chongqing? And how could these shifts shape the long-term value of the local property market?
I think I was reading a China Daily article recently, and they were talking about, I think it was aluminium plants moving to sort of southern China or western China. And I think there are tremendous opportunities. I mean, Chongqing fundamentally is a sort of more of a manufacturing hub. Chengdu being more consumption and services led, but Chongqing has that incredible industrial base. And for the Chinese economy as a whole, industry, manufacturing is always going to be in its DNA. It's always incredibly important. It's a strategic sector that is always going to be invested in. And I think Chongqing plays a significant role in that sort of nationwide vision as well. And obviously, from that manufacturing base, that then creates opportunities in terms of population inflow, economic growth, having to have offices to be able to manage those manufacturing plants. That generates retail, R&D, and everything else as well. But that's the fundamental sort of core of the Chongqing market going forwards.
As China's property market moves from expansion to optimization, the sector is entering a new phase. With supportive policies in place and the market continue to adjust, cities like Chongqing, with strong manufacturing foundations and room for industrial upgrading, could provide stronger support for the market's long-term recovery.